Welcome back. You're still watching Smart Money on CNBC TV 18. We're speaking to Radhika Gupta of Edelweiss about the growing category of passive debt funds and how you can add it to your portfolio, specifically talking about short-term index funds on the debt category side. You know, the other thing, of course, we want to know is which are the schemes that are available to invest for short-term index funds, these short duration funds that you spoke about.
So this one is the first one in the market, this Edelweiss, and it's got a very long name, but the Edelweiss GSEC short duration fund is the first one in the market. Its typical comparison has been actively managed funds, but I'm hoping just like with Bharat Bond, we opened the market to lots more competition joining. I'm hoping this market will expand because it's genuinely a consumer need. Everyone needs a savings account equivalent that's more efficient where you can park your money.
Okay, but you know, at a time like this, right, Radhika, of course, you've tracked both equities and debt very closely, fixed income very closely. How do you feel the asset allocation strategy should change for the full year? I mean, equities looks like it's going to be a very frustrating and painful period this year, may not give people too many returns. There may be a time-wise correction as well amidst this whole global uncertainty. At such a time, do you raise your allocation to debt? If yes, how do you construct your portfolio?
You know, I've always been a very multi-asset investor. I've been a firm believer in asset allocations, even in the equity heydays. And, years like this, I think, justify that belief. You know, when we see equities, while we are constructive from a 3-year point of view, we do know that the next 1 year is going to be volatile at time. In fact, our equity theme is recessionary conditions before returns. So I think debt is a core part of the portfolio. Now, as far as debt portfolio construction, I have a very simple rule. You break your money into two parts. Money that you need in the short term, which goes into an instrument like the short duration index fund. It's money that you may use for 1, 2 years, 2, 3 years. I may buy a house. I may need some money for construction. I may need it for something. I may not. Otherwise, it can just sit there. And then money that's a little more goal oriented. The goal oriented money, like I have goals for 3 years, I have goals for 5 years, I have goals for 10 years. I match the timeline with the goals of a target maturity fund and park it there. So that's how I like to do my debt allocation. It's goal oriented and I divide it into two buckets: money that I may need now and then money that I park away for goals.
The short duration index funds, right, that you spoke about, the debt index funds. I mean, just playing the devil's advocate here, if I need the money in the shorter term, I just want to park it for a smaller period of time, I can park it in various other places, whether it's in, say, of course, FDs or in a liquid fund or in a sovereign gold bond, or, you know, there are so many other places to park it. Why should I look at short duration funds?
So, liquid, of course, liquid, I believe, is not for money that you want to do for 2 to 3 years because, there is an interest rate spread that you get if you're hanging out for 2 to 3 years. FDs work, but, the good thing about a short duration index fund is if you do choose to keep the money for 3 years, you get the advantage of indexation. Believe me, for those of us who are fully tax paying, that becomes very large. So this gives you that optionality of being able to take it out early. But if you happen to keep it for 3 years, you get the benefit of taxation. And I've seen with a lot of us, Sonia, we think we have short-term money, some of it ends up being long-term. So I like the optionality built in something like this.
Actually, you know what? I made a mistake. I said sovereign gold bonds. Sovereign gold bonds actually are for the longer term, right? I mean, you get the tax benefits only if you hold it for 8 years. I meant gold ETFs. So that was my other, the other avenue. Yeah, tell me. You were telling me about gold ETFs?
No, I don't compare gold to debt because gold is a little volatile as an asset class, right?
It is. So how are you feeling about gold now? I mean, it has done really well compared to equities in the last 1 year. And people are now talking about raising their allocation to gold in their portfolio. You're not a believer of that?
We launched a gold fund in August last year, a gold and silver fund, and it's up a lot of money. But I said then what I'm going to say now, which is that I think gold should be a static allocation in your portfolio. It could be 5 to 10%. I feel investors do a terrible job of timing gold, and I remember this from my own NFO. So I think not trying to time gold and just keeping there at 5 to 10% works much better than trying to time it.
Okay, by the way, before we wrap up, congratulations are in order, Radhika, because Edelweiss has crossed the 1 lakh crore AUM milestone, and it's a big deal, right? I mean, I have watched your journey over the last 10 to 15 years, and it's been phenomenal, the growth that you have seen and now the growth that you've brought to Edelweiss. So congratulations. But do you think that a lot of this also has to do with the massive rise that we've seen in the equity cult, right, in the Indian markets, especially with retail investors? And do you think that's here to stay?
I think it is, and I'm very thankful for the growth. And the wonderful thing is, I think mutual funds have become so mainstream. They've become part of popular culture almost. We've seen our equity AUM grow by 15 times in the last 5 years. We've seen our fixed income AUM come from basically zero to what it is to being a top 10 player in fixed income. And I think the young Indian investor, the Indian investor, is getting more aware about their money. They want to financialize more. They're also getting more aspirational about their money. And that's where you see the rise in equity. And I genuinely do believe that while 1 lakh is a meaningful milestone, I do believe our MF industry will go from 40 to 100 lakh crores. And we will also go from 1 to 2 and much larger. So I'm very optimistic about the future because financialization is just starting to kick in.
Absolutely, I totally agree with you. And now we're, of course, with the onset of digitization, you're seeing easier ways to sort of get into the financial market and invest your money. Tell me a little bit about, let's get back to the topic, of course, with respect to passive funds and passive debt funds. What kind of an average return would you expect, both in the short-term index funds as well as overall in the passive debt category over the next couple of years?
Okay, so I think the short-term index fund YTMs are between 7 to 7.5. I mean, it changes given the day. It could be 7.1, 7.2. And I think that's where sort of short-term rates are likely to be. We do think we're close to the end of the rate hike and rates are not going to go down in a hurry. So perhaps the timing of this one is also good. For longer term passive, debt funds, the target maturity series, it really depends on where you are in the yield curve. But we have products all the way from 2023 till 2037, which sounds like a long time away. And I think they go from 7.1 all the way to 7.7. So that's kind of where you should be. And I should take the opportunity to re-highlight that most people don't realize that post-tax on a mutual fund platform, you end up paying tax with indexation and tax works out to 10-12%. So you really, versus a traditional instrument, end up being better off.
So with this passive debt category picking up in India over the last 2 to 3 years, Radhika, do you see investors hunting for diversified products? Do you see that switch from equities to fixed income or to debt increase? Or is it largely still skewed towards equities?
No, I don't think equity and debt, are the comparison points. I think equity has its place in the portfolio. It's a risk-taking asset class. I think with passive debt funds, where we are seeing money come from is erstwhile tax-free, because we are 50% of this very, very large market and growing market. We see money come from tax-free bond investors. We see money come from fully taxable FD investors who now want to enjoy the predictability with much lower taxation. So we see it come from these categories. We see many first-time fixed income MF investors come in because of target maturity funds, because finally they've found a product that's safe, that's predictable, that's low cost. So debt and equity, I've always believed, are different parts of the asset allocation. But investors who never used debt mutual funds or who use things like FDs or tax-free bonds are now coming to passive debt funds. So that's where we see the growth coming from.
Okay, I'm sure there's a big party happening at Edelweiss now with the 1 lakh crore AUM milestone getting hit. So are we looking at the IPO coming anytime soon?
It's a great aspiration to have, Sonia. I think we're focused on building a high quality business, a profitable business, which we've got to. And hopefully in the next few years, we can scale it to a point where we become a listed company at some point. It would make all of us very proud.
Okay, Radhika, it's always a pleasure speaking with you. Get to learn so much from you. Thanks a lot for joining in. Just one last question before we let you go, because the topic of this week or the topic of the last many weeks has been what's happening with the churn in the market with respect to different sectors, right? There are new age tech companies that are coming back. There was this whole Adani Group fiasco. Consumption is slowing down in a big way, and a lot of foreign investors are talking about it as well. What are the themes that you like now? Not just at Edelweiss, but personally as well. What are the sectoral themes that you like?
We think this is a decade of India, India manufacturing, beneficiaries of PLI. So the themes that are sort of in our portfolio are long domestic India. So it is industrials, it is capital goods, it is beneficiaries of a pickup in private capex, PLI, indigenization of defense. And I think the second theme that goes hand in hand with this is financials, especially lending financials, because they benefit from this stage and this uptick in the economy. So we really believe it's going to be, a very special decade for these themes, and that's what we're overweight on. That's my personal view as well. And things that we're underweight on are typically things that tend to be more export oriented because global conditions this time are more challenged versus domestic conditions.
All right, Radhika Gupta, always a pleasure speaking with you. And once again, congratulations to you and to the entire team at Edelweiss for achieving this 1 lakh crore milestone in the AUM. So thanks a lot for joining in and all the best for the future.
Thank you, Sonia.
Okay, with that, folks, it's a wrap on this edition of Smart Money. As always, keep writing to us. Thanks for watching.